following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So it is Saturday, and we are talking all about money. So there is so much talk right now going on about inflation and the beginning of a bear market. So much talk, in my opinion, it's all talk. Talk about the Buffett indicator. Dynasty Wealth came out predicting that there's going to be a bear market lasting for another 8 years. Just don't believe. I just don't believe. And we're going to come and talk about that. You want to hear what my guest has to say? She's going to talk about social media and websites. She has a lot to say about that. And you know that if you've been listening to the program for a while, I really dislike annuities. They don't work for most people. But I have a special illustration today because Pacific Life is being sued because they're defrauding their customers with a universal life insurance policy. They developed their own index, so you can't see if it's true. Their estimates show that they're making 50% on just covered calls, and 50% per year. No way that can happen. And their illustrations are showing how you can hyperfund this, something that looks wonderful, but it makes up to five times the commissions for the insurance agent. That's very significant. We're going to talk about that, but I want to begin with this whole talk about inflation and the bear market. And yes, I've talked about inflation, and I do believe inflation is on the way. And I do believe that it's coming, a significant amount of inflation. But I believe it's a slow process. It's not an immediate process, and I don't believe that it's here now. But there's talk about a bear market. Just because rates on the 10-year Treasury went from 0.75%, a little under 0.75%, to almost 1.5%. So I want to talk about that. There's a relationship over the long term between inflation and bonds and stocks. There was a study done by Jeremy Siegel out of the University of Pennsylvania. It's a study that is pretty famous. He talked about the equity premium of stocks and bond returns since 1802, 200 years. A studying of how stocks and bonds and inflation relate. He said that short-term treasuries, the short-term treasury bills, on the average are about 0.5% over the rate of inflation. Long-term treasuries are about 1.5% over inflation. And historical inflation is run at around 2 to 3%. So that means that those 10-year treasuries should be trading between 3.5% and 4.5%. Right now they're at 1.5%. People are getting all excited because they've gone from less than 0.75% to over 1.5%. They're way under what the average has been for 200 years. Actually, treasuries didn't exist 200 years ago, but bonds did. Government bonds did. Municipal bonds did. State bonds did. But over that period of time, and for stocks, it's 6.9% over the rate of inflation. So it is all about inflation. Think about this. When you're buying a bond, if you're going out longer term, there's a risk for inflation. You know, if inflation picks up, you want a higher return. So you pay for a longer term bond 1.5% higher, or you should receive 1.5% higher to compensate for the risk of inflation. For stocks, you have not just the inflation risk, but you have the risk of the stocks not working out and going to zero. So the premium over inflation rates is 6.9%. You know, if you look right now, If you look right now, the inflation rate for the last 12 months has run ex food and gasoline, food and energy. The inflation rates run up 1.3% over the year. Going back and looking at 2019, it was running at 1.9%, 1.7%, which means that the Treasury, the 10-year Treasury, should be trading at around 2.8, not 0.5, not 1.5, but should be significantly above that. And in fact, Jerome Powell, when he was asked, said that he expected the 10-year Treasury to trade in the rate of about 3 to 4%. That's why Treasury yields have been so low, is because of the pandemic and the fear of falling GDP. It's not just in the U.S., but worldwide. The U.S. Treasuries are the flight to quality security investment. When people begin to worry about what's happening, other countries, our country begins to worry, people begin to buy Treasuries. They're looking for protection of principal. And so what you have, when we started into the pandemic, you had a rush to buy U.S. Treasuries. And already U.S. Treasuries were at a low rate as we recovered from the Great Recession. People are hedging against GDP and economies not coming back as fast. So why are they rising? Well, the very reason that they were buying the bonds in the first place, to hedge against the worldwide economy coming undone, they're beginning to see the end of the pandemic. They're beginning to see GDPs rising, not just in the U.S., but worldwide. And so you have governments that are beginning to sell, and no longer with the great fears of hedging against a recession or depression. The pandemic's going away. Fear's subsiding. And yeah, inflation has ticked up, but it was even higher in 2018 and 2019. I mentioned 1.7%. It was actually 2.4% at the end of 2019, 1.7 including energy and gas and so on. So if you look at what's happening, we're probably going to continue to see a pickup of inflation in 2021, more so than even in 2019. We're seeing labor rates rise. We're seeing commodity prices rise. That yields and pushes inflation, but not to extreme values yet. We're going to get back to a normal relationship. We're going to get back to the 10-year Treasury trading at 3.5% to 4.5%. We're going to see stocks continue to rise. But since the bottom in 2009, stocks have risen about 16.5% per year if you look at the Standard & Poor's, which is way over the 6.9%. But if you go back and take it going through two cycles, the bear market of 2000 to 2009 and the bull market of 2009 to 2010, actually, the Standard & Poor's has risen 6.757% with dividends reinvested. And if you adjust it for inflation, the CPI, stocks have achieved a return of 4.686%. That's a full 2% less than they should be yielding under normal circumstances. So if you look at the last 20 years, stocks really look to be undervalued. And that's kicking all this stuff about inflation and bear markets coming, which brings me back to the Buffett indicator. Because Buffett was asked in 2001, remember 2001 is after 2000, and 2000 is when the dot-com crashed, and by 2001, stocks had plunged down over 35%. Buffett was asked in 2001 what he thought about stocks, and he mentioned that people could evaluate, and he thought stocks were probably overpriced in 1999 because they were they'd grown twice as fast as GDP, and that became known as the Buffett indicator. That was the first mention, 2001. And Buffett, when you consider Buffett, He's a bottom-up stock picker, just like I am. We're not looking at stock market in total. We're not looking at sectors. We're not looking at specific areas. We're looking at the individual stocks themselves, the individual companies, how the price stacks up compared to the value of the stock. He's not buying the market. He doesn't look at the market. He does think that when everybody is greedy, it's a time to sell, and when everybody is fearful, it's a time to buy. But he's a bottom-up approacher. He didn't even look to make his decisions at what the GDP was or what the stock market was. So if you look at the Buffett indicator, the trend line itself has been going up. If you look at how the GDP compares to the stock market, the line has been going up. And what does that really mean? Supposedly, some people have taken it if stocks are increased 180% compared to GDP, they're overpriced. But if that's the case, then they've been overpriced every year since 2004. If it's double, they've been overpriced every year since 2012. But the big question is not the stock valuation. It's GDP. And we're going to come back to this question right after the commercial break. Don't go away. You want to hear the rest of the story? You also want to hear what my guest has to say about social media and websites. And I want to finish about annuities. Stay with me.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So I've been talking about the Buffett indicator. I've been talking about all this talk about inflation kicking up, about the market going into a bear market. And the big talk now is the Buffett indicator. Almost everywhere you look, people are talking about the Buffett indicator, at least those who are predicting bad times ahead, talking about the Buffett indicator. But you know what? There's something else that's wrong with the Buffett indicator. Not that he used it. He didn't use it. Not that it's one of those things which has been rising and then falling and rising and falling. If you draw a regression line through it or a line, there's a slope. And that slope is increasing. And stocks are moving up faster than the GDP. And there's a reason for that. If you look at GDP, the United States is 16% of worldwide GDP. 16%. Approximately 1/6 of world GDP is generated in the U.S. But if you look at the revenues of all public companies, 43% of their revenues come from overseas sales. Just a little under half of the revenues come from overseas sales. And it's been growing over this period of time, growing from about 18 and 19% to 43%. So the fastest growth of revenues for public companies has been coming from overseas. But the Buffett indicator only uses U.S. GDP, but compares that to the revenues of all public companies. So either you have to remove the sales from overseas, which would put the Buffett indicator and GDP in line, or you have to use worldwide GDP, which again brings the Buffett indicator into line. There's a concept that's called the illusionary truth effect. And what that is the tendency to believe false information to be correct after repeated exposure. So if you hear enough about the market crashing down, about inflation, about the Buffett indicator, about some of these other indicators, it begins to take on a credibility. It's an illusionary truth effect. And that's what we're seeing. Even as stocks climb higher and higher, there will be some that see patterns. You know, if you saw a coin flip and it came down heads, 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 and then tails, 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 you begin to think, or you might think that that's a pattern. But you know what? That coin flip of heads, 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 tails, tails, tails is no more nor less common than head, tails, head, tails, head, tails, head, tails. But people see patterns where they don't exist. If you want to try it, flip a coin 64 times or flip a coin 6 times and do that 64 times. And the odds are that you will see one time, you will see heads, head, heads, tail, tail, tail. And one time you will see head, tail, head, tail, head, tail. It happens on the average once every 64 times. But people will see where patterns exist or see patterns where none exist. One of the most famous economists, he shared the Nobel Prize in 2013, looking at financial advisors and money managers and how they perform compared to the S&P 500. Eugene Fama of the University of Chicago, probably the #1 economist in the world today, talking about stock market and impact of the stock market. Fama started when he was a graduate student, taking down stock prices and looking at the patterns. And what he found is when he found a pattern, and when you're listening to all these people talking about Buffett indicator, talking about Fibonacci curves, talking about all these things, what they're seeing are patterns. And what Fama discovered is he would see a pattern, and he might find it from someone who was writing about a pattern. But what he also found is the pattern did not repeat. It seemed to be there, but it didn't repeat. That's where this stuff is going. There was a presentation at the Money Show. You know that I talked at the Money Show last week. And it was a presentation that said the market was topping out, that we were going to see a bear market for the next 8 to 9 years. And he used the Buffett indicator as a justification. And by the way, he mentioned that he's willing to manage your money just to keep you intact. And he does not charge that much to do that. Oh yeah, it's a scare tactic. The idea is to scare listeners into paying him to manage your money. That's the agenda. That's the cause. And you know what? The thing is, you can sue somebody if they lose money for you on their advice. But if you just take $10,000 and make $10,000 over 10 years, that's 1% per year on a $1 million account. Actually, it's not 1%, it's 1/10 of 1%. If you make that much, that doesn't even keep up with inflation. You could do much better anywhere else, but you can't sue anybody because you made money. You didn't lose money. If you lose money, investors can sue people who gave them that advice. So even though you don't go into a bear market, if you allow somebody like that to manage your money, you can't really go back and say, I should have made a lot more money. So if you look at the fundamentals, from March 2000 to 2001, stocks have achieved 6.7% with dividends reinvested. And if you adjust that for inflation, less than 4.75%. It does not say that stocks are overvalued. It says stocks are undervalued. But there's lots of people who want to scare you out of the market. Their agenda is to scare you out of the market and into their arms. And they find all sorts of patterns. The Buffett indicator is just the latest one. The Golden Cross came up about 10 years ago because as we were going through the Great Recession. In the years following the Great Recession, you had a lot of push about the Golden Cross, or as some people call it, the Death Cross. Ninja traders, they were called. And before that, you had the Fibonacci curve that was giving you sell signals. And before that, you know, the fact is, heads, 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 tails, tails, tails. It happens sometimes. And so does head, tails, head, tails, head, tails. That happens sometimes too. That doesn't mean the coin is fixed. It doesn't mean there's a pattern that really exists. It just means by chance, 1 out of 64 times, you're going to see heads, 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 tail, tails, tails. Statistically, it happens once out of every 64 times that you flip a coin six times. Try it and see if that doesn't happen. The damage that's done is selling out and being out of the market. The lost opportunity cost. The fact is the market will go up and down. You are going to have fluctuations, but the overall trend is up. The risk is being out of the market, not in the market. So to wrap this up, I want to mention that I'm going to be doing the Money Show this coming Thursday, the 18th. I'm doing a presentation called Breakout Portfolios, Seeking to Achieve Outsized Returns. And while everybody is looking at forward forecast and looking at these very difficult, scary times, I just show you what I've done and what my clients have done. It's a virtual money show. You can register for free. Just go on, log on to the Money Show, register. I will be speaking from 9:40 to 10:10 on the 18th, Thursday. There will be a question and answer period that will follow that for another 30 minutes. And then we will break off the Money Show and do a Zoom for another hour. And in the past, I've had people continue through that entire time. So that's coming up Thursday, the 18th. That's this coming Thursday, 9:40 to 10:10. Register before. The actual Money Show will run the 16th, 17th, and 18th. I'm speaking on the third day. And I'm speaking about breakout portfolios seeking to achieve outsized returns. Subtitled, Higher Returns Do Not Necessarily Mean Higher Risk. I like it because I'm doing it. Anyway, I recommend that you do that. And with that, I want to introduce my guest today, Amber Wheeler of Pacific Creative Studios. Welcome to the program, Amber.
Thank you very much. I'm excited to be here.
So just before we're coming up to a break, but before the break, just give us a quick background of what you are and what you've done.
Okay, well, I mostly, I like to work with people on their digital presence, focusing on things like their website and their social media, especially at a time when people are more involved with the internet than they were a year ago. Having an online presence is super important, and it's something I grew up with and around, so I have knowledge, and I like to use that to educate and help others, in particular small businesses.
So that gives you a little preview of what's to come right after the commercial break, so don't go away, because we are coming to a commercial break. And if you miss any part of this program or any of the other programs, you can find us on YouTube. This program will be downloaded to YouTube in this coming week. You can hear this program. You can hear about what Amber has to say a second time. But stay with me through this commercial break so you can hear what Amber has to say. Websites are really critical. So is social media. It's something that you want. If you don't have, you should be involved with. If your website is dated or stale, you need to think about updating it. We're going to be talking about all those things once we come back from this commercial break. So don't go away. And do come listen to me at the Money Show. It's a virtual show. Registration is free. And I'm speaking from 9:40 to 10:10 on Thursday the 18th. And there'll be a question and answer period after that. So stick with me. We'll be right back.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm speaking with Amber Wheeler of Pacific Creative Studio, and we just started with a little bit of her background, but you grew up with computers. Take it from there, Amber. Tell us more.
I had a home where in the late 90s we had a computer and access to the internet because my mom was working on her thesis. And I've always been sort of techie and interested in computers. So I took to the internet at a young age and started building websites because it was fun. My mother tried to tell me, someday people will pay you to build websites for them. And I just thought, no, Mom, no one's going to pay me to do this. I just do it for fun. And regrettably, it's one of those things you hate admitting, but my mom was right. So, and then with social media, it started with MySpace, and then it grew into Facebook, and of course other social medias then came into play. And so I sort of hopped on the train, and I got involved with a lot of them in order to stay in contact with my friends. And then of course it turned to more of a business dealing where people muted their businesses on social media to connect with customers and socially listen. And I like to help business owners with that as well.
Okay, so let's talk about what you do with websites.
Okay. I do all sorts of things from website remodels, so a website that already exists that just maybe needs a refresh, to full-on hosting and building and management of websites. So from start to finish, all the way through, one side or the other. I do what I can to help people with the knowledge and skills that I have.
So let's talk about the process. If someone wants to build out a website, if they're beginning from scratch, where do you begin? What's the process?
I usually talk to them first about their business because this sort of becomes their online calling card for their business. It's where people are going to go to get information. The hard truth is that these days people don't really use the yellow pages or the white pages when they're looking for business. They're looking at Google. And if your page isn't on Google, especially the first page of Google, you get looked over a lot. So having a professional-looking web page is also important because people will, if you don't look professional, if you don't load fast enough, people click away and don't give you a second thought. When we're building a website, the first thing I do is I sit down with the business owner either in person or over the phone or on Zoom and discuss with them about their business, what their message is, what their branding looks like. If they don't have that, then we work on it together to get it in place for the website because I want the website to represent their business and the feelings they want people to have about their business.
So and you get some ideas about color schemes, and what about atmospheric feeling? What is that?
It's sort of the same idea like when you walk into an Apple store, for example. It's big and it's wide and it's well lit and it's just simple, much like their devices are. Whereas if you walk into a store like Lush or Bath & Body Works, you tend to have more of a farmer's market approach. It's hands-on. People want to touch things. People want to smell things. So it's the same kind of idea with your website. When people log onto your website, it gives them the feeling that you want them to have about your brand. Is it dark? Is it light? Is it colorful? Is it simple? There's a lot of things that go into it that matter about the feeling you want people to have about your business, and appearances are part of that. So
when you look at websites, there's usually a number of pages. How do you determine what pages you need, what you should add to, what needs to be changed?
Again, that all happens in that conversation I have with businesses about their business because not every web page needs the exact same thing. There are some standard things like a landing page, the home page. You should have a contact page where people can fill out the form to get in touch with you. Oftentimes an FAQ or frequently asked questions is a really good page to have. But, if you're not offering, say, an online store, then you don't necessarily need like a storefront page on your website. But if you're offering services, you should have at least information about your services, if not the ability to purchase those services from your page. So it really depends on the business. And I feel like every website is different. Every business is unique. And so it's worth it to take the time to learn about the business so that when I'm building a web page, I build something that does their business the service it deserves.
So what about somebody who's got a website, they've had it for 4 or 5 years, and after 4 or 5 years, they may not realize it, but it looks tired.
Mm-hmm. Mm-hmm. So the biggest thing is making sure the website is now mobilely optimized. The majority of traffic to your website is coming from a cell phone rather than a computer. So being able to access the page and have it look right on the cell phone is important. Same thing with what your initial message is. People have a shorter attention span when it comes to getting their information they're looking for. The internet has given us such an ability to get information immediately that if they can't get what they want really quickly, they're going to move on. So a lot of pages, older pages in particular, kind of start with this big, long introduction to their business. You know, we started in 1970, and it was passed down from our grandfather, and this and this and this, whereas people just don't, you know, if the information they want isn't right when they click, they usually click away. So having a message, a short and to the point message at the beginning, rather than a big, long paragraph, is going to make a difference, whereas 10 years ago, that may have not been the case.
So let's shift gears a minute, and I want to encourage people to, if they've got a website, if it's old, if it's tired, they should be talking to you. If they haven't got a website and have a business, they should be talking to you. So how would they contact you?
You can visit my website, which is pacificcreativestudio.com. They can also find me online through social media, or they can give me a call, and the number for that is 360. Now that I'm on the radio, I'm forgetting, of course. I have it in front of me, though, fortunately. It's 360-504-8106.
Okay. So let's shift gears and talk about social media, because that's something that has arrived, and people need to really be doing that. So tell us what you do in terms of social media.
Well, with social media, people oftentimes go to social media to have more of a relationship with the business. So if your business is not on social media, you're missing out on a big relationship piece with your business, because a lot of business, especially now, does better when you have a relationship with your customers. And even if your online presence isn't necessarily as two-way as maybe you'd like it to be, it's still a relationship-building activity. It's also a place where you can go and listen to what the needs are of your customers. So if you're part of, say, Facebook groups or anything like that, that have to do with your target market, you can listen to what the needs of your customers are. And if you're not filling that need, you can always create something that does fill that need to relate with your customers more.
So tell people how they can get in touch with you about social media and websites, or both. So again, give us that information.
Sure. My website is pacificcreativestudio.com, or you can email me, Amber, at pacificcreativestudio.com. You can also give me a call, 360-504-8106. So
I encourage listeners to do that. If you don't have a website, talk to her. If you're concerned about social media, and if you don't have a real social media presence, talk to her. And some of us don't have time, so we need somebody in addition to ourselves to do the social media side. I recommend you talk to Amber. If you've had a website for 4 or 5 years, it's probably old and stale. You should talk to Amber too. So she's inexpensive but very good. You get extreme value for what you pay. So thanks for being on the program, Amber. And one more time, tell people your contact information.
Sure. My website is pacificcreativestudio.com. You can also email me, Amber, at pacificcreativestudio.com, or give me a call, 360-504-8106.
Thanks, Amber.
Thank you so much.
So if you've been listening to me for some time, you know that I don't like annuities. They have a place for a few people, but it's very few people. Annuities are really oversold. And what I have today to talk about is one of the annuities that has an illustration that shows that it's one of the best in the industry. Actually, it's not an annuity. It's a universal life policy. But the same thing that went on with this universal life policy is probably happening with annuities too. And because it's very visible, I want to share with you about the Pacific Life PDX, and hopefully, if you're a listener, you don't have it. If you do have that universal life policy, you should be involved with the class action suit that's going on. And I'm going to be talking about that. I'm going to be talking about the fact that Helen Olin wrote a book called Pound Foolish, Exposing the Dark Side of the Finance Industry. And she said there were two things about annuities. First, they're increasingly sold to baby boomers worried about running out of money. And second, they're so complicated, so difficult to understand, so many financial penalties, that even Susie Orman, who's not one of my favorites, doesn't agree with owning an annuity. Annuities are sold for one and only one reason, according to Helen Olin. That's to make money for financial advisors. So I'm going to talk about this whole thing coming up right after this commercial break, so don't go away. You really need to hear what I say, and especially if you're being approached about doing an annuity. I'll be right back. Stay with me.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So I've started talking about annuities, and if you've been listening to me for a while, you know about once every 6 months I get on a kick where I begin to talk about annuities and do a program on annuities, and I want to do it again. Helen Olin wrote the book Pound Foolish, Exposing the Dark Side of the Finance Industry, and I've drawn a lot of information from what she wrote, but I'm also drawing information from this lawsuit that Pacific Life is being sued for their PDX Universal Life product. You can actually go and Google. You can Google Pacific Life. They're being sued by Hong Lee. It's a class action suit. So you can go look up all this stuff that I'm saying. It's almost unbelievable because they're being sued. Actually, if you read it, you almost have to be terrified because they're being sued for fraud and deceit. They're being sued for intentional misrepresentation. They're being sued for breach of fiduciary duty. They're being sued for professional negligence. It's stated in the suit that they're the riskiest and most leveraged product. They're saying it's impossible to understand. It's impossible for agents not to sell because the illustrations show that they're the best in the industry. And those tables, those illustrations are the tables that the agent shows you how well the policy will do over the next 20 years. Those are the very best in the industry, but they're misleading, and it doesn't explain and notify you of the risk that are in it. They claim that they produce outsized returns when they knew they would not. You know, at Adams Financial Concepts, we also claim outsized returns, but what we're talking about is what we've delivered to clients and what we publish on our website. What we publish in When I'm Speaking shows that what my clients have done is actual performance, and it's not just cherry-picking clients. It's 100% of my equity clients are included in that. And it shows what they've done over the last 16 years. It's not a short-term thing. 16 years. It shows net of all costs, net of all expenses, net of all fees. It's an actual verifiable track record. What we're talking about with, or what's being talked about in this suit with Pacific Life is their forecasted illustrations. What's going to happen over the next 20 years? And they're talking about outsized returns. They're projections into the future. And you never know for sure what's going to happen into the future. You can just look at how they're structured. And the index that they use, it has a mysterious thing they call the performance factor. So they take the index and then they multiply it by a performance factor. And nowhere in the policy does it ever describe what it is, how it's derived, or what the formula is. They say in the document, in the policy, they're using call options. They're buying call options, and they estimate they will generate 50% profit on every transaction using these call options. And they're saying they're going to continue that into perpetuity. They use that. They use that to justify very high fees. They're collecting high fees. And they call options, and they leverage what they're doing. They borrow money. They borrow the stocks, and they leverage things on margin to create a significant amount of risk, and none of that is ever disclosed. And the other thing, it's a universal life, which means it's a variable life policy. And if the returns ever become negative, and they will from time to time, either the owner gets to pay additional premiums to make up for the loss, or the policy will lapse, and you lose the policy, and lose all you put into it so far. Those are policies. Not only is that the basic, but they give you all sorts of bells and whistles. It becomes complicated. They add things to the policy. You can buy, for example, to guarantee the death benefit, you can buy a portion that gives you term life insurance. That's an additional amount to it. You can add inflation adjustment to it. You can add all sorts of things. And when you do that, each one of those extra options costs money. And in addition to all of that, you can do hyper-funded. Oh, before we finish with the bells and whistles, the insurance agents who are selling this policy can earn up to 3 times higher commissions if they steer customers into taking all the options, up to 3 times the normal commission. But in addition to that, they can be hyper-funded, which means you make payments for the first few years, and then as it builds up cash in the policy, you borrow the cash out to make the ongoing premiums. It sounds like you're getting life insurance for no cost after 2-3 years. I understand this very well. In my 20s, I bought a life insurance policy, a whole life policy, and I used the hyperfunding. I paid for it for the first 2 or 3 years, and then I borrowed cash out of it, borrowed against the cash value to make the premiums. And I did that for a number of years. What I didn't realize, for 25 years, the impact of what I was doing. For doing that, what you do is you create up to 5 times the commission for the insurance agent. You pay a certain commission for the policy by hyper-funding. Every time you do that, the insurance agent gets more commission. So, and on top of that, I was borrowing from the cash value, and I was paying interest on the loan. So I'm borrowing my own money, paying interest on my own money, and I'm just simply taking money out of the policy. If I die, if I would have died and collected on the insurance policy, I would have received the policy less the loan and the interest. So here I am, borrowing money out of the policy, paying interest for borrowing my own money out of the policy, and when I die, all that gets written off against the policy. Not the normal thing, and my agent made 5 times what his normal commission would have been. What a deal. What a deal. So now you begin to see why early in my financial career, when I started with Payne Weber as a rookie stockbroker, we all did our insurance license. It took me less than a year to get rid of that license and to get rid of doing insurance. Never do I want to do insurance. That's That's not in the best interest of the client. That's not fiduciary. It is something that I just could not agree with. And yes, it's important for young people to have life insurance, especially term life insurance, when they're young and they have a family. But over a period of time, the idea is to build up your assets. So you don't need insurance. You can leave a nest egg to your heirs. You can cover your retirement. You can provide for a life after retirement. That's what you should be doing. But in the beginning, life insurance is important. Life insurance is the type of thing where it's like fire insurance. You hope you never, ever need it. But if you do need it, you really have to have it. That's life insurance. And that's important for the beginning. But all these things that have been added, the policies that have been added, and the commissions they're creating, and as Helen Nolan says, they're done for one and only one reason, and that's to create money for the financial advisors. I don't believe that it belongs in many people. I believe there are a few people that should have annuities, and most young people should have life insurance. So that wraps it up. Have a very good weekend and a very good week, and I will be back next Saturday. Join me Thursday to hear me talk at the Money Show.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.